Welcome to Talking Tuesday. I just wanted to welcome Michael Jordan Pilgreen to the channel.
It's great to be here. Thanks for having me on. I'm excited to talk to you again. It's been a few years since we've known each other.
Yeah, so it's been great. So for the people that don't know, so we met, I think it's about 5 years ago. You reached out, interested in quant finance, and you're like the perfect guest, I feel like, because you have this very interesting journey and process, right? It's never like, I don't know, I always tell people, right? You go through the undergrad, then you do the master's, then you do the quant finance. It seems like this really straight line. And yet I never really meet anyone that does that. It's always like you end up getting to some weird point of quant and then you pivot and find some sort of direction on that. So why don't you just kind of talk a little bit about, I guess let's just start over from you. Like, how did you get interested in quantitative finance?
For sure. I think in life nowadays, everything's an evolution. And, luckily, from a very early age, I was always very good at math and was always in the advanced math programs. And, when I got to undergrad, I went to a liberal arts school, Rhodes College in Memphis, Tennessee. And everything was about breadth and depth there. So exposing yourself to a lot of different things, learning how to really go deep on just niche subjects that you may never use again, like Russian literature, Baroque art history, just random stuff you never think would apply. I did a writing major, so I was an English major in college. I was like, I've done a lot of math. My senior year of high school, I did the Calc 1, Calc 2 track. So I was like, everyone was pushing me into engineering. I was like, let me just try something different. Ended up getting an English degree, was an artist. I did sculpture, metal fabrication, murals, poetry throughout college. I really thought I could support myself doing that. And then sort of the COVID pandemic woke me up, I guess. All the corporate art jobs I was doing just sort of went away with uncertainty. And I was like, well, let me try to find something stable. So I was like,
Yeah,
you know,
I feel that.
so I was like, all right, everybody's like finance and technology is growing. And I'm, being sort of focused on English and poetry and art history. It's very macro in scope. You're thinking about long-term history cycles, kind of like where you are in the world, like you're pulling in philosophy into it. So you're using all these points of views and sort of lenses to look at the world. And I became really good at like adopting new lenses. So I was, one of the first books I read in finance was The Adaptive Market Hypothesis by Andrew Lowe. I mean, just a brilliant book, but just like gives you the overlay of like finance as a whole from the capital markets perspective, but also kind of how do you take on these viewpoints that people are actually institutionally trading with? How are portfolio managers thinking about things, and how you can assess the environment and, for lack of a better term, the organisms or the entities in that environment. And everything just clicked for me. Then I was like, all right, so there's this quantitative side to it. Obviously, like if you want to be fluent in finance and capital markets, there's some quantitative work there. Like you just can't not know what net present value is, not know how to do relative valuation, like, or at least understand the frameworks where we get to those conversations. Because again, I said this in high school and my math teacher always loved it. Like, one of the reasons I love math more than English in high school was because numbers don't lie. That's what I used to say.
Yeah.
Now, of course, when you start diving into quantitative finance, you understand that it's really just like an English lens to things. Like people have their assumptions
Mhm.
about the world and how it operates. So they're building what I'll call just their foundational models before the equations even enter the scene, before you get to the Excel page or anything like that. So really, it started the quantitative finance journey with I had been practicing English the last 4 years, doing a lot with art and thinking about the world, but I knew I needed that quantitative strength and some type of mark to make that entry point into being credible as a financial professional. So that's kind of how it all started. I started going down the FA track, but we can get into that a little bit more if you want to talk about it.
Yeah, no, I think it's an extraordinary perspective because I don't think a lot of people view it from that macro setting, right? As your journey's going through this, looking at this as more of like a liberal arts, history, English major, which seems completely broken in quant finance, right? Like, as soon as you hear the word liberal arts and English, like everyone just kind of runs like the other way, like, oh, this isn't quant. But I think it's very important, the point you made, which is every sort of portfolio manager, every model developer, every strategist, every person in the quant finance industry has a bias, right? They have some sort of perspective or lens. And interestingly enough, a lot of that is impacted by history. So like when you pull out like fresh students, I always look at their history and it's, 2 years in the market. They've never seen a downturn in an economy or anything. And then you look at somebody who's 65, 70. My old boss, I think, was like 72, 74. I was working with him. And he had kind of your perspective of like this very large, like, I don't know how to say like fluid or more dynamic perspective, but it's because he had seen that historic perspective of how the markets change and evolve through that. So I think it's a critical
Sure.
point for like listeners to understand is having different backgrounds often provides these kind of different unique insights into markets and also the quant space.
So just some weird things that kind of shaped my initial like intro into finance. I did Andrew Lowe's course on MIT OpenCourseware. It's free on YouTube, so you can look it up. But it's like a master's level intro to finance theory course. And he's recording it during the Great Financial Crisis.
Okay.
And I'm taking this course during COVID. So
Yeah.
so
The
it's
irony.
like two of the biggest financial crises, arguably in the 21st century, happening kind of simultaneously, and I'm trying to figure out the puzzle, right? And one of the books I read early on was like Trillion Dollar Triage, which is just kind of about all the Federal Reserve facilities that opened up during COVID. I was a beneficiary of the unemployment insurance during that time. So I'm taking the unemployment check. I'm looking for a job frantically and trying to learn like finance and technology along the way. And yeah, so all those factors like really shaped how ultimately came to like see the markets once I was working in them.
Do you still feel you have kind of that artistic, I guess, thread? Because you seem to have like this understanding of art and you just list off casually, like, metalworking, glass. Is there any specific type of art that you feel like has influenced kind of your thought process over the years?
Yeah, for sure. I think even learning like how to code, I think was influenced a lot by like, everybody's like, you're born either an artist or not, right? Like you know how to draw just intuitively or you don't. But the truth is like just like writing where like there's structures, there's formats, there's kind of foundational blocks. That's exactly how drawing is. Like, if you spend 10,000 hours drawing, like you're gonna be a master drawer, right? And like if you are lucky enough to like find the knowledge initially from like people that understand all the concepts, um, you're going to accelerate a lot faster. So I think that's like for me with every subject and especially with coding, it was like, because everyone's like, they say coding languages, right?
Yeah.
And I think it's more like learning how to use a power drill or like, like, especially for data engineering and things of that nature. Like, of course, there's like, structures and foundations, and you can get into the weeds on everything. But the ultimate thing is like, especially nowadays with most people using Python or PySpark or things like that. I mean, when you're doing functions, it's dot select, dot filter, dot add, like
Yeah, the
if,
basics there.
yeah, if you can understand basic English and logical deduction and all those things, like it's more so like how do I use it correctly? And I think learning kind of all the skills early on, like, all right, this is how you draw, all right, this is how you paint, all right, this is how you paint on a wall, this is how you edit a graphic design and then put it to scale. I think all those things, or even like printing things like CMYK versus RGB, like people hear arts and like they don't think it's technical. But a lot of art is technical, especially when it comes to like commercial production and there's money on the line. You did RFQ and all this stuff. So I think all those things just like opened me up to the possibility that I could learn the thing. And even like just like some willful naivete around it all was like, if you can learn SQL, you can learn Python, so I think it's just like take everything in stride and perspective and know that you're going to be bad at it until you're good at it, like, and just keep showing up. And I was doing one thing at one point in time where I was like, I use this service called Data Camp. And basically they have courses on there for different skills. And I was like, if I can do 1 to 2 courses a day, so they're about 2 to 4 hours each, and I can make 3 to 5 phone calls a day, something's gonna happen. I don't know what's gonna happen, but something will happen. So that was kind of just my whole perspective on it.
So would you I guess that we'll ask that question. How would you recommend somebody go the quantitative finance path? And if they're interested in it, what steps would they take to get there? Because it sounds like you had kind of like a plan. Like you don't have necessarily a narrow like shot of like this will guaranteed work, but it sounds like you did have like this functional mapping of like how to get to that world.
Yeah, I think it'll be better if I take a step back. So like when I was first trying to get into finance, I was thinking, I'll just be a financial advisor. And like that's sort of like the entryway, like retail financial advising is just like, building a business. If you're lucky, you get into a training program and they scale you up. And I was on the track to actually got an offer to get into a 4-year training program where they give you a salary and then they step you down as you get clients. So it was like the FA dream to say, but throughout all that, I'm like, well, I know about the CFA, the Chartered Financial Analyst track. I know about, different tax specializations. You can get the CFP, the, Certified Financial Planner, all this stuff. But I didn't really understand what any of it meant, to be honest. Like, I just knew they were like something that you could strive for. So I just started reading the CFA books. Like, I got the textbooks and I just started reading them. And throughout like that process, I started to understand like the CFA is really for like institutional money managers.
Yeah.
And so there's like, not knowing much about finance is kind of like when people talk about technology where they're like, well, if you're a technologist, you can do front end work and back end work and SEO. Like you can do anything with technology, right?
That's
And
so
I think
broad.
and I think that's kind of what I thought about finance too, like, but then the more you learn, the more sophisticated your approach to things can be. I think at the beginning, I was just trying to brute force and like getting back to your question, like, um, do I recommend quantitative finance? I think anybody that works in financial markets or finance in general needs to have some understanding of the quantitative aspects of the industry just to be able to have conversations intelligently. I think like whether you should go full like I'm going to be a quant, develop models, work in an investment bank, work at Jane Street, that type of thing. I think that is sort of like a third level question that a lot of people skip the first 2 levels.
Yeah.
Like,
Yeah.
well, they're like, I'm going to be a quant by any means, and it's like, all right, I mean, are you sure you like that? Are you sure you want to do that? Do you understand? Even like you can tell a lot from just questions people will ask you when they're talking about wanting to do a quant career. I think a lot of people get to the desire of wanting to be a quant from the potential financial gain.
Yeah. I find there's kind of two paths. There is the academic math dreamer that thinks that like I sit down like with one of these books and I pull out like a textbook and I sit down and like I'm like writing out math proofs. And then I think then you to your point, right, there's the other part which is probably a lot more popular, which is like you can make a lot of money. And I think those two things, to your point, is kind of like a you're skipping everything and just jumping to like I heard there's an outcome from this, but there's not a lot of thought on well, I enjoy doing this over, 25, 30 years of a career, or is it more of a short kind of term dream in my mind?
Yeah, and I think a lot of people kind of cut themselves short too, because like while quants do make a lot of money, there's other careers in the investment banking world that make a lot more money, right? Like, so I
That's
think,
that's the big secret though. That's what I keep telling people. They ask me and they go, we always have the selection bias, right? It's like when you say like, "Oh, I'm going to work in tech," and what does everyone think about? They think like, "Oh, I'm going to be like Mark Zuckerberg, Elon Musk, Steve Jobs," and I look at it, and I go, "It's like a selection bias. Like where all those people, those thousands and thousands of people working underneath them that are not making millions of dollars, making good salaries. Like don't get me wrong, but they're not making millions. We do the same in quant, where everyone goes like." I was just on Reddit. I hate being on Reddit, but I was on Reddit and it was like looking like famous quants. And I'm like, who could I invite to a conference I'm planning? And of course, it's like Ed Thorpe, Fisher Black, Emmanuel Derman, Ray Dalio. Again, Dalio, not a quant. But of course, people think he's a quant. Ken Griffin, not a quant, just runs a quant fund. And so it's like you're going through these names and it's the same kind of thing you're talking about. I think everyone sees the salary of the person that's like the outlier. And everyone's like, how do I be an outlier? But to your point, you could be an outlier in tech. You could be the world's best like neurosurgeon. You could be the world's best marketing professional, world's best football player. Like, I mean, you could pick anything as an outlier, and the compensation will be wildly different. But I think that's a great point of people are often looking at those famous people and not looking at like what is the average Joe like me doing on a daily basis instead of the crazy, the movie. I think the movies and the books ruin it. Big short,
that's also like Ren Tech, James Simon. Like you
Yeah.
got all the, I mean, we do hear a lot of success stories, but to your point, and it's like, like if you're a quant on the traditional path, I mean, like you can make the same career trajectory as like an analyst on the same path. And you can argue like those careers are like becoming more and more intermingled and you need the same skill sets in both nowadays. So I think that's the thing that a lot of people don't understand. And like, it's funny because like when you're in financial markets, like those are the back office people.
Yes. I,
Like no one respects them.
I keep hearing people tell me too. They go, dude, I want to be a quant. I'm like, really? Like, yeah, I want to work in the front office. And I'm like, those are not the same sentence. Front office
Yeah.
is here, back office, quant is here. The traders, the decision makers, the PMs are here. And then they always say, like, oh, I want to be a trader or PM. And I'm like, then you don't want to do the quant route. Like,
Yeah.
don't go that path. That's going to be a lot of wasted time.
Exactly. No, I find the same thing. Like, and that's why some of these training programs are good to get into, or like get an internship early, and like hopefully you get one that like has some rotational aspect to it, where you can get exposed to like front office, middle office, back office work, and just kind of get your head around what the roles really are.
Yeah.
Because, I think that's helpful for a lot of beginners. It's just like, research the roles. I think it's the same with like data science, right? Like a data engineer versus a data analyst versus an ML engineer. Like all these or versus a data scientist. Like all these are going to be different skill sets with different workloads. There's going to be some overlap, but like, they're all just different careers. So you got
Yeah.
to be aware of that.
So how did you, I guess let's rewind a little bit. What were the original jobs you had, like kind of getting through this? And why did you select not to go into like the financial advisory? Let's start with that.
Yeah, so all right, basically it was like October of 2020. I had basically the FA, the 4-year program in front of me, and then I had an offer to do this fintech apprenticeship program with the hopes of landing a job after it. So
Okay.
it wasn't even a guarantee like that I was gonna get the job. I talked to kind of all my mentors because at this point I had been talking to so many people. I was just like, talk to my mentors, my friends, my family, and they're all like, well, if you're gonna make a bet and take a risk, you're young enough to do it right now. So I was like, all right, I'll take the bet and the risk. Continued like studying for my CFA throughout. There was like a 3 month lag before the fintech program started. Fintech's program started in like January, and every day I just showed up like this, like stood out. There was people on the call like they had their cameras off, that showed up in a t-shirt,
Yeah.
just like, and I'm looking for a job, so I'm like on the hunt. Every time there's a question, I'm like putting my hand up to answer it. I'm connecting with the speakers after the calls, like just doing anything to really try to like break through. And basically, one of the main teachers was the CEO of the fintech I later worked for. And I just kind of hounded him and people at the company until they made me an offer. So, so I think I was making like, it started out as like a consulting role where I was making like $1,200 a month or something like that, like just not enough to live on. And I'm like kind of kicking myself in the head, like, why did I do this when I
Yeah.
had three X or 4X promised to me a month, 6 months ago. And basically they're like, all right, we need help with Salesforce. And, we have these salespeople that are selling the trading desk. And it was sort of just like getting thrown right into the market. So like the company focused on consolidating pre-trade institutional pricing data for the corporate bond market. So we were basically getting all the quotes from dealers, trying to make the order book so that, buy side participants could look at that and get the best execution primarily. And, it was a weird time too, because like during that time, the Federal Reserve was still, maybe they had finished making corporate bond purchases at that point, but it was like, all right, this is needed, right? Because basically at that point, everyone was, you know, figuring out reference points for pricing from either evaluated pricing providers or from like Trace itself. So like post-trade transaction data. And like one thing with corporate bonds too is like these instruments aren't always trading.
Hmm.
So the frequency, typically what we call new issue, like right when the bond's released and subscribed, you have a big flurry of trading activity for the next 3 months, 6 months, and then it sort of dies for the rest of the life of that bond. And occasionally, as rates change and things like that, maybe there's, a new interest or like if there's a new issue for that issuer, maybe it affects the curves or whatever. But for the most part, that's kind of how it works. So, and the other thing with trades too is you don't actually know. You generally know if it's a large institutional or a medium institutional or a small institutional trade,
Okay.
but you don't know the full amount ever. So you're like, all right, I got a signal that someone's transacting in this bond, but I'm not sure, on all the details. So I think that was really fascinating to me because, at the time, I think it was also like Wall Street's bets was really huge and like all the equity markets are going crazy and high frequency trading and the retail revolution or whatever you want to call it. And there was just like a lot of hype around the markets and like efficient market hypothesis. And here I am in a bigger market with bigger transactions and 80+% of the volume is still being done over the phone or over Bloomberg chat, So I think seeing all that, and I was always like really I've always been a big central bank watcher, so like watching that real time get applied to the market you're in, you just learn a lot of macro things that I think if you start in the equity side of things, you might miss. I mean, you still have an appreciation for the Federal Reserve, don't get me wrong, but I think things are a lot more like news based, like bond markets only respond to negative news. Like, you know what I mean? Like if you get downgraded or there's
Yeah.
bankruptcy talks or mergers talks, that's kind of like when markets respond. But in equities, like a tweet goes out and someone's responding or trading on that.
Can you share a little bit about like what are the sizes of bonds? I don't know if a lot of people are aware of this. Like when I've studied quant finance, there's always equities, 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 and then there's like, oh, this fancy shiny derivative, but we hardly ever talk about fixed income. And if we do, we talk about like this is a corporate bond. This is how payments come out. But nobody talks about the market parts of that. You want to talk a little bit about like you kind of hinted on, right? There's a lack of liquidity within these. But also you want to talk a little bit about the sizing of these and some of the data issues around like there's not some really nice pretty data feed where you can just like log in and like download these. Because also from a quant perspective, right, it's hard to model. Because there's no
For
data,
sure.
nothing to model off of on that data itself.
I'll just start at the basics. So like
Yeah, please do.
so, when we're talking about equity instruments, like most of the time we're talking about like common stock. Sometimes there's preferred shares, classes, but mostly they're, you can compare them pretty easily for one issuer, and there's one instrument per issuer usually, right? The thing with bonds is, and you'll hear anybody that talks about bonds talk about this, is the introduction of idiosyncratic risk per instrument, which means, all right, so I'm an issuer. I might have 30, 40 different instruments outstanding right now. So across those instruments, so if I'm a single issuer, we can assume my credit rating is pretty much staying the same just for simplicity. Um, if my credit rating is the same, then the differences between my bonds are going to come down to coupon and the maturity. So, like, what's the coupon I'm giving? So, like, typically every 6 to 12 months, I'm paying a coupon to the bondholders. And just in like the capital formation, one reason people like bonds is because typically, not always, they can be secured or unsecured. But I'll have a claim against the business in the most negative catastrophic outcome. So if they go bankrupt, I have some claim on the business, and I can get that back through bankruptcy laws. And this is one of the kind of nuance that it's hard to talk about macro markets with people that don't really understand this is like one of the things that set America apart for so long is our robust bankruptcy code and precedent.
Mhm.
So
Yes.
a lot of this comes down to, court filings in Delaware over the last 100 years, 150 years. But there's some type of certainty with how things will play out in the worst case scenario. And that goes into credit rating, all that stuff. But and that's why when you see like people talking about erosion and trust, especially with currencies not being asset backed anymore, like that's why it's so important for fraud and bankruptcy to be kind of dealt with the same every time. So when there starts becoming times when you're not dealing with that the same, that affects markets in a more dramatic way than people realize. And I think that's hard for a lot of people to comprehend right now. Just every administration has a different regulatory regime, and
Mhm.
yeah, so we'll see how that pans out for the U.S. But to get back to the get back to the point a little bit, like you know, so if I'm looking at maturity, typically, when I'm thinking of like lending credit to a corporation, the longer they want to hold my money, the more money I expect in return. So on any given issuer, if it's a 12-month, if it's a short-term liquidity thing, like 3 years and in, I'm going to charge a different amount for the risk premium than if it's 15 plus years out. And, there's some corporations that do 50 year, 100-year bonds, like,
Oh wow.
so
Okay.
not many nowadays, but it's definitely out there, and there's perpetuity bonds as well. So how you're calculating those cash flows and all the things that you need to take into account. the fixed income markets just become quantitative a lot quicker because you can't just it's not apples to apples. You're not looking at the PE ratio and then, deciding how you're going to value things. You got to look at, all right, where is this in the capital stack? Do they have enough money to service this debt long term? Do I believe, in 15 years they're still going to have that same cash flow? So it becomes a lot different, just valuating and then relatively valuating all the bonds. Everything basically ties back to the treasury curves. So,
Yeah. Yeah.
how I look at the treasury curve is going to affect how I look at all the US corporate bonds. So I think that's some of the nuance that like starts to make fixed income a lot different from equities.
Yeah. And I think one of the interesting points was contracts and laws. I never thought too much about it until a lot of international students keep asking me like why is quant finance huge in the US? I think I heard like a stat years ago. It's like 70% of all quant jobs are in the US. And then this last year I worked through a securitization. So I did all the modeling, met with the rating agencies, did all the jazz. And it's essentially like bonds almost in a way. It's fixed income because you have all these assets which are backed, and of course they don't mean anything unless you have a law or some sort of legal structure behind that. And then when you do the securitization, it's again a securitization is nothing more than a legal contract. It's we have a bunch of, in our case, subprime auto loans. These people are going to get paid out first. You're an A tranche. You're going to get paid out second, third, and I think that has made quantitative finance even back to 2007, 2008 with like CDOs and all this other sorts of contracts interesting is the legalese. The legalese of it is just like an interesting perspective that makes quant finance happen. And to your point, when you don't have that, like there's nothing you can do because there's no sort of expectation of how you put that together.
I think that also gets into like why the credit space, even asset to asset, so collateralized loan obligations, like your credit cards versus student loans versus auto loans versus corporate bonds are just dramatically different in how you're going to approach quantitatively valuating things. Like most credit card companies are non-recourse loans, right? Like if you don't pay, nothing happen. I mean, you lose some credit score, right? But like, I mean, they're not gonna come take your kidney or your house or your family. You know what I mean?
Yeah.
Whereas like, subprime auto loan, they can come take your car most of the time. So yeah, it's an interesting dynamic when you start getting, and ultimately, like that's why I think debt is a lot more fascinating than equities because like there are these like legal and trust structures that underlie everything. And that's what makes it not as simple too, because, when you start, how much does trust cost? I
Yeah.
think that's that's the question everyone's asking themselves this year, even, like it's become pertinent to every discussion is like, you know, how much do I charge for trust? Like how much do I trust or how reliable is the person I'm trusting, or how predictable, all those things factor into, it's even like the Bank of Japan stuff this week, like a huge liquidity crunch in the Bank of Japan's markets. And they ended up holding the rate yesterday, but like, it's just a lot of people don't understand that, understand the implications of the financial quantitative models you need to be, incorporating that into.
Yeah. I think it's an interesting quote. There's a quote I believe it's from Emmanuel Derman's My Life as a Quant book. And he mentions in the book that, equities are tend to be viewed as like a gambler's paradise of like non-quantitative, seat of the pants kind of industry. And they're not viewed as very quantitative as when you shift into fixed income, because fixed income is very law-based, very data-based. The math works out quite well. And to your point, there's much predictability in that. And I think that is an interesting paradigm because we now see the shift now where everyone feels like the buy side has done this tremendous marketing job. I probably contributed probably to all the movies. Like everybody thinks like the traders and the buy side and the equities teams are like where all the quants are sitting. And like that's where it's at. And I'm looking at like you realize 2007, 2008 was based on legal contracts like CDOs and mortgage defaults, MBS and all that. That was actually all on the fixed income side. But when you ask somebody, what do you want to do when you grow up? How to be a quant? What do you want to do? Investing on the equity side. And you're like scratching your head like, where is this coming from? But it's an
Yeah.
interesting paradigm of how perception versus reality in that job market is unique. But also how fixed income is it's very complex. I don't think a lot of people give enough credit to that.
Yeah, and I mean, you go to your equity derivatives and they're a lot simpler to think about. You got your Greeks and things like that. But I think the interesting thing is like for equities, we take for granted an order book.
Yeah.
Like, all right, so let me tell you now, like, fixed income doesn't have a centralized order book, not even in really the US, let alone globally. So, and I mean, you can get into it, but like for some government bonds, there are order books, but for corporates mostly, there's not. And if I don't even know where the actual market is today on an instrument, but then I have a third level derivative that isn't as clean as an equity derivative, and I'm trading that daily, like, so then it just starts to be like, all right, so how are buy side institutions even justifying like best execution with like their fiduciary responsibilities, at the portfolio level? Because like, are you just looking at the last transaction that happened 6 months ago when you made that trade and like that's your best X mark? Because that has a lot of implications even at the retail level with your retirement accounts. Like,
Yeah.
so I think that's the interesting thing about it. And, also kind of what people don't understand is like, all right, so there's a trading level, there's a portfolio management level, there's the sales level, the institutional sales level, but then there's the regulatory regimes, there's the trade associations, there's the market infrastructure pieces, and all these people have different agendas. And by the way, these are all different jobs like
Yeah.
that employ thousands of people, you know? So, and you always get back to it like, what's the proper way to develop market infrastructure and like, what is true market transparency and like, how do we make this closer to efficiency, right? Versus, there's a lot of big players that benefit a lot from opacity. Because
Yeah.
look,
Oh yeah.
if you have a small budget for, and this is another thing you got to consider is like market data providers. Like if I'm a smaller bank, and I don't have a multi-million billion dollar data budget, how am I competing against a bulge bracket guy, that can scoop up all the market data, basically have the best picture, and then they're just taking advantage of me. So I think all those things kind of like go into it, and like those are the interesting little pockets to explore if you're like getting into finance, thinking about a quant career, because it's like once you start putting all the pieces together, there's just a lot more careers that you could
Hmm.
go into and like learn from. But also, just knowing those pieces also make you a better quant. Like, because I understand like if I do this strategy, how's it going to affect other entities in the marketplace? And like, are they doing the opposite of me already?
The data side has always fascinated me because to your point, there's always all these stories and information and how things are done behind the data. But I'm not a data person. Like I don't know, like as we're talking about fixed income on the corporate bond side, it's like I don't understand the lack of data and issues behind it. But then to your point, as you start to get into these careers, you start to realize like this is like a specialty. Like there's a whole knowledge base you have to know to be an expert in that space. It's not just like I'm gonna go become a data engineer or something and like it's the same at every firm and product type.
Yeah, and I mean, I'll try not to use any names just to keep it high level, but like even instrument level data is hard to get for people. Like there's people like, get into it a little bit, but there's QSIPs and then there's ISINs, so like the International Security Identifier Number. So there's even arguments about like, all right, what's the reference data that goes to this ISIN if I can't afford the market data?
Okay. I didn't know that. That's interesting.
So like, what's the coupon associated with this ISIN I'm seeing tick across, right? Like, what's the maturity date? Because I don't have the money to afford the reference data. There's some initiatives like Fiji. I don't know if you're familiar with them, but they're like open source instrument reference data provider. Um, but like just going back to it, like, all right, so if I'm a debt capital markets desk and I'm doing new issues all the time, there's a fee and a toll I have to pay to make sure that the QSIP gets done right
Yeah.
and that we're all talking about the same instrument right now. Because there used to be like guys would just be writing numbers. Like they just be writing numbers and people be like, we're trading that one today. But like and that's also where the industry of the whole thing comes along. Also like getting access to treasury data, swap data, like being consistent because that's where your curves are coming from. And if you don't have real time data or you can't afford to, like, that's going to affect everything in your models.
Do you think we'll ever get to a more standardized system, even like in the US with data? I know, I think as you're mentioning, right, a lot of the hurdles are one, things aren't traded very often. And then two, there's often a lot of more or less like a private deal where it's like somebody, I pick up my phone, I call you and say, hey, I need, 200 million in, whatever bonds. You say, great, and you sell it at some price. Do you think we'll ever get to some sort of more standardized framework to help get closer?
Yeah, so there's a lot to this. So like the market reference data, I think for the most part, there's high quality industry providers, and most people can agree on like you know, what the reference data is. I think it's like 99% there. I think where it gets complicated is when you start looking at the global fixed income corporate space. For the US, it's pretty standardized. You just have to pay the toll, right? But as far as like, and I think this is a tough thing about regulation and deregulation sometimes because when you hear about it, you're thinking, well, deregulation spurs business growth, regulation restricts business growth. And I think for market infrastructure, that doesn't really apply the same way. For me personally, this is my perspective. I'm always for like smarter regulation, more harmonization, like, because that's what's going to make liquidity and, depth of book increase over time. But I don't think we get there without a regulatory push, honestly, because there's no incentive for the big guys to adopt it.
Yeah.
So like if I'm a big bulge bracket and you're Vanguard or and you call me and I got a good relationship with you, I'm gonna give you a different price than I give Aflac, right? Like it's just the name of the game. And you could put in any big liquidity provider name in there. It doesn't necessarily need to be them, but it's just kind of the reality of it is like this is still just relationship based. And whereas equities, you don't see as much as that, I think. So I think that's the difficult part.
I gotcha. That makes a lot of sense. We see the same in risk. Like I try to explain to people when a financial crisis happens, everyone's like, "Oh, the market's going to tank. There's going to be no jobs." I'm like, "There's going to be a ton of jobs, all in the risk space, because now we realize we need more regulations and more risk."
Exactly. And that was one of the things when I first, like during COVID and like learning from the great financial crisis is like anytime there's volatility and displacement, that's good for the financial markets,
Yeah,
right? Like people are going to get the biggest bonus they've gotten in their career this year, like it's just a different and it makes sense because like, if you think about it from a fundamental level, like getting to your most basic thing, like a bank lends money for a percentage of interest.
hmm,
And as interest changes, they make more money. Like, and volatility makes it even more money because then I can be like, well, I got to charge you a risk premium now because I'm unsure, right?
exactly.
So I think that's the part just to like intuitively understand about it.
So after you worked in fixed income, what was the journey after this? You've taken like a pivot towards like what is talk a little bit about what you've worked on after you left that job working in bonds.
Yeah, for sure. So, just to go back a little bit. So during that time, obviously, I wasn't a Salesforce intern the whole time. I was kind of tasked with like re-architecting the whole platform moving to the cutting edge technology. So I spent a lot of time researching and then developing, we were, you know, a basic startup platform stack at first, and then we ended up doing the most cutting edge technologies. So the data and AI capabilities were all there in the foundation now. But I always tell people it's like bringing Jetsons technology to a Flintstones market. Like, what are you gonna do with AI if I can't do like, honest, just algebra based work, right? Like, so I think that was one thing, but I think that taught me a lot about like other markets because other markets become easier when you go from like the complexity to other things. So, I did a lot of consulting work with fintechs around the world, different things. Some things focus more on like hedge fund analysis tools, like for specific strategies, all the way to like, AI and machine learning. Like I worked with a company that was doing like a proprietary RAG type software where basically like um, you could focus the LLM to just internal documents.
Okay.
And that would also come with citations into the, reports that were cranked out and stuff like that. So how do you make, because this is always the thing, people are like, well, OpenAI is going to disrupt financial services. And I'm like, how do you figure like you can hire all the ex-Goldman people you want? It's still gonna be the toughest problem you've ever solved. Like
Oh yeah.
because
Yeah.
because there's so many regulatory and compliance, you know, hurdles to get over that like a foundational model on its own just isn't going to be able to do. So like I always find that funny because they're like, oh, they're going to take over, all the Goldman analyst jobs, and I'm like, it's just not going to happen. So I worked in that space, and then I had a brief stint in venture capital where I was helping just like hundreds of different types of companies get ready for fundraising, but also thinking about like enduring business practices. And I think through those experiences, I learned a lot about just like the contemporary American entrepreneur mindset. I think, what's so crazy to me is like venture capital at most is like 35 years old.
Yeah.
like,
It's a very
like
new industry.
Like if you were doing venture capital in the 90s, you were like working with C-suite executives that had been in the industries for 40 plus years that were like real business people, real professionals that knew what they were looking for because venture capital was just so there wasn't much supply. So, your ability to secure those funds had to be a lot, your confidence had to be a lot higher. And now we've seen and I go back and forth on venture capital because I think venture capital is one of the last professional money managers that doesn't require licensing.
Okay.
And so to be a GP at a VC firm, you don't need any license. Like it's basically a free game. We're like, coming from the capital markets, like Series 7, Series, name your series, like to be in a specific position, um, you know, outside of the CFAs and all the other add-ons that you kind of need to have to rise in ranks. But I think there's two things. There's like the acceleration of entrepreneurialism, which I think comes from the lack of gainful employment opportunities. So basically, people can't get a job that's going to train them, that's going to cultivate their career anymore. The window's smaller and smaller. You basically need to be a savant or a genius to like get that type of, you know what I mean? Like you got to have a certain skill set and adaptability, and for a company to basically invest millions in you over the years, like I mean, between healthcare, between your salary, between your professional development. So I think with those opportunities shrinking, quant finance is one of the few places where that's still sort of available to people and somewhat attainable. While it's not accessible to everybody, but if you're able to demonstrate you have the skill set, you can find something. Um, So basically, what were people left with? Go start a business. And then with the Shark Tankification of everything and like people are like, well, I gotta have $1 billion business. And I think a lot of people just like it was lost on them that like if I can make a few $1 million a year,
Mhm.
that's amazing. Like,
Yeah. Yeah.
like if you can make a few million, they all were like, I gotta be a billionaire, I gotta make billions, and I think like this acceleration brought, a lot of capital into venture capital. There was some easing of like restrictions for institutional limited partners so that they can invest more into venture capital. And you see it in university endowments and all this stuff now. And I think, I think that's just it's kind of like the selection bias we were talking about earlier, where like you see Mark Zuckerberg and you think, I didn't go to Harvard and I don't have the Harvard network, but I can do the same thing that he did. And, so I think just being in the venture capital space, after doing it for a while, it's just like, honestly, people just need to make small, sustainable businesses. Like,
Yeah.
so,
I mean, I think with tech too, you see that with a lot of the VCs blowing up and being this big industry now. I think it's predominantly sitting on tech. Because to your point, you don't see someone coming out being like, I'm going to manufacture like this really cool like steel part or something, and we're going to grow it into this big business. Like the olden days, I think with technology, it's so much more scalable because you can make one software product and then mass produce it with limited resources in that space. And I think to your point, talking about LLMs and AI and finance is scalable and tech is scalable, where when you see traditional businesses, manufacturing and hard assets, those tend to be much, much slower and harder to build. Where like, you have an awesome app. It's like, all right, what is it? Like, let me just buy it here real quick. I don't have to go to the store. I don't have to go do any research on it. But I do think there's a lot of that tech space that's kind of blowing up the VC space with it. Especially right now with AI. I see so many like, ridiculous ideas, but they're just dumping money in because they've got to put money somewhere.
yeah, and I think also it perverts a lot of incentives for management teams. Like, all right, so the number one thing is ARR. I'm just gonna do a foundational model wrapper, pick, your company, and this is now gonna be the sales AI assistant, right? I'm not gonna have an SLA when my foundational model company goes down, I'm going down. Like, it's just like all this. And then all I care about is sales because that's what's going to drive an investment.
Mhm.
And I don't know if that's sustainable business practice. I don't know if that's gonna and like to your point, like it's just saturated with stuff like that. And ultimately, like, I mean, my prediction for this year and next year and maybe the year after is like everything is gonna be defense tech. Like everything's defense robotics, and if you're able to do it data and then you just have to tack on AI to it to make the pitch nice and
Yeah.
clean and sexy. But it's really a data business. Like, so I think that's kind of where things are going. I think defense is just going to be huge, but I think the barriers to entry are higher. So you're left in this place where people can't find really good employment and then they're dreaming of being a billionaire. And I think more people just need to like, all right, let me just make a successful small to medium sized business and do it with good practices. And that's what I focus on, like with the enduring partners business I do. So that's just like, how can we take a step back, make sure your intentions are aligned with the actions you're taking today, and be thoughtful about creating a business versus chasing some dream. Like, that's not even yours, probably, that you just were sold to through social media and other
Yeah,
things.
yeah.
It's like have your own dream and follow through on it.
You want to talk a little bit about that? Is this like what spurred enduring markets and how did you get going with this and what's kind of the goal of it?
Yeah, so Enduring Markets, that's my capital markets publication. I just wanted to turn my passion into central bank watching into like consistent articles and newsletters. And then I started realizing compilation of institutional news was a good niche too. So I have like my Sunday newsletter about the central bank rates for the week. And then if they're G20 companies, I'm going to cover them as they're happening. But, I mention everybody, but the G20 is kind of what I focus on. And then Friday is sort of like my institutional news review. So, where trading talent's going, what happened with the central banks. I try not to sensationalize it too much. So I create all the central bank news from the actual monetary policy committee statements. So I'm not bringing a lot of commentary into it. So I'm trying to keep it just like, this is what they said. Even if you can't trust the bank, this is what they said,
Yeah.
like just trying to keep it there because, if you watch the Federal Reserve the week before and the week after is all these headlines about what Jerome Powell said and not what he actually said. You know what I'm saying?
Yeah. Yeah.
So,
And it's always the big
so
headline like US economy could see, greatest recession in history. And then you read it and you're like, oh, he said they might, lower the rates a little bit or they might increase
yeah,
rates. And you're like, okay, like,
exactly. And then part of it is too doing like content creation and thought leadership for capital markets professionals. I think with enduring markets, I'm really focused on that because and this goes back to my undergrad degree, like bridging writing with quantitative and institutional finance. Like a lot of people struggle with writing about institutional finance in their own voice. So how do you help someone find their own voice? How do you help them sustain that voice for long periods of time and make it consistent, right? So that's really where I'm focused and kind of getting a lot of traction with institutional clients nowadays.
nice. Yeah, it's a hard space to be in. I don't know if a lot of people realize this. Like, when you go from working in capital markets and having that knowledge base, it's very hard to do like content creation or have a voice, whether it's because companies are too concerned you might say something, um, or there's not a lot of, it's hard to monetize. So one of my biggest struggles as a YouTuber and talking about quant finance is I don't really monetize anything because I don't feel like there's a way to monetize that like responsibly. And it's hard to find your voice and how do you be unique in that space versus it's very easy to look online and like, oh, this is trending. Like we could talk about, some trendy thing, but trying to find, I guess, kind of your cadence and kind of your like what drives you.
Yeah, for sure. And I think a lot of people try to use AI, but the truth in this space, at least, and this is the hard part about like using LLMs for, sustained voicing and messaging is like LLMs inherently are past looking tools.
Yeah.
Like
Yep.
it can only reference things that's been published.
Yep.
So if I want to talk about the future or proprietary things or do my own data analysis and data storytelling around internal reports or documents I have, it can't do that. Like it just frankly can't do that. So that's where I'm like, all right, so if I'm looking forward looking, the vision of the future, that's a niche I can capture on because LLMs just can't do it. So I think that's one thing that I've also picked up. And to your point too, I think the best and most moral thing I've seen with like monetizing at least capital market information is through teaching. I think that's, because things that you take for granted as basics, if you tell to someone else, their eyes are either going to glaze over because they don't care, or they're going to be like, everything, like
Yeah.
stuff. So I think it's balancing that and then like admitting when you don't know something. So I think that's kind of the sweet spot for monetization in this space. And I see it with a lot of like we didn't even get into it really, but like with repo leaders, like a lot of repo leaders will teach other people how to be repo traders, how to think about repo, because that's one of the derivatives from like even fixed income that a lot of people don't understand is like, all right, so and securities financing, right? Like if I'm purchasing a stock or a bond today, I'm not just going to hold it because then where's the cash I need?
Hmm.
I'm going to loan it out overnight to someone or for a couple of days for cash. and then that creates a whole nother market. So I think that's also an interesting space for any, aspiring quants to look into as well.
Yeah, there's a lot of interesting spots. Even like just through this discussion we're having, it's like my experience is here, your experience is here, and it's like we're touching on the adjacent fields and people in there. So it's definitely a deep field to study.
Yeah, and I mean that's what makes finance and macroeconomics to me so fascinating because like I don't know, I'm a person that's always been led by curiosity.
Hmm.
And the more you learn about this stuff, the more you learn you don't know.
Yeah, yeah.
And maybe 20 years from now, I'll be like, well, I've seen it all. But even so, like there's stuff that I'm seeing today. Like I just saw something like some guys are trying to bring crypto perpetual futures to traditional assets and or like tokenization of assets, all that stuff. It's like there's new innovation
Hmm.
and different asset classes that can be applied to traditional assets and like, where does that go? What does that do for market structure and transparency? So I think it's a just the evolution of things and if you try to keep up with everything, you're just going to get overwhelmed and burned out. But like if you
Oh yeah.
have your interests, follow your interests.
All right, so one final question here for the podcast. If you had to recommend one book, doesn't have to be finance, doesn't have to be business, as an artist, as an entrepreneur, as a bond specialist, like what is just one book that you is like your absolute favorite and why?
Maybe I'll do two.
Okay, go for it.
So I think for me, adaptive market hypothesis for anyone trying to be in finance is really important. I think Andrew Lowe is just one of the few teachers gifted with the ability to make complexity simplicity.
Yeah.
And he goes through, he's got another book, Random Walk Down Wall Street. Like if you're really into quant stuff, like I highly recommend that one. But it's just being able to understand these points of view and see them as lenses versus absolute laws to the universe. I think a lot of people want to talk about quant finance or just finance in general, like the laws of physics,
Yeah.
or and things are just a lot more messier and human than that. And so I think that's for my finance people. And then, this is really weird, but kind of one of my all-time favorite books. I'm very like American focused, so like Invisible Man by Ralph Ellison is one of my favorite books. It's just like this nameless narrator that could be anybody in the world, just like constantly getting projected other people's visions of himself and him trying to reach those visions of him through other people's eyes. I just think it's a great book just for any like human being moving through the universe and it just touches back on like what I think America is founded on, like the ideals of Ralph Waldo Emerson and like our founding fathers, like we're like a pluralistic society where diversity only strengthens us. And I think that's a message that's not talked a lot about right now, but I think that we need to get back to. I go all this anti-globalization talk. When I worked on Wall Street, one of the things I loved about it was the diversity of people.
Hmm.
We had the best people from all over the world bringing the best ideas to the table and figuring out what was going to stick. And that was what made financial markets stronger, what made them more robust, made them more liquid. And I think this turn against that is just in the long run and medium term going to be detrimental to financial markets. So that's just my general opinion. So Ralph Ellison, Invisible Man, definitely read it if you haven't. It's a long book, but it's worth the read, and you might not understand it all. There's a lot of Southern intricacies to the book that you might not get at first, but once you get through the halfway point, just seeing kind of like the evolution of the American through the eyes of the Invisible Man, I think is it's a good one to revisit in this time, I think.
Awesome. Michael, thank you for coming on. I really enjoyed having you.
Of course, thanks for having me. It was great talking to you.